All right. Good morning, everyone. Welcome to Veterans July webinar. Today, we're going to be talking about mitigating global credit risk at scale. I'm Nikki Sneed, and today I'm joined by Dhruv Hare. For those of you that are new, welcome. And to the names that I see that have attended our webinars before, welcome back. This webinar will be recorded, and we are going to share the recording and the presentation after this afternoon with everyone. Additionally, as I'm sure you've all noticed, this webinar has been set up so that you've all been muted, but that does not mean that we do not want to hear from you. In fact, quite the contrary. We'd love to hear any questions, comments, or points of reference that you may have about the things we discussed today. If you'd like to share something, please use the Q&A feature at the top of the screen. It should be right up there. And we'll be monitoring that throughout the webinar, and we'll have extra time at the end for any questions. So let's go ahead and get started today. Here's what's on the agenda. First, I'll start by introducing myself, Dhruv, and Bectrin, and then we'll dive into the presentation. Today, we're going to be talking about the globalization of business, the benefits and reasons it's vital, and also the risks that come in unfamiliar territory. We'll talk about some ways to mitigate risk in new areas and then dive into considerations for mitigating risk globally. Finally, we'll discuss actionable strategies for international business credit. Of course, the main thesis today is all about global credit risk, but all of these considerations and strategies are best practices for businesses of all sizes. The goal today is to provide you with the key takeaways that you can walk away from here and begin implementing right away. We'll also show you what all of this looks like from an electronic point of view using Vectrin, since this is one of the most critical services that we offer our clients. And in the end, like I said, we'll do a Q&A session, so please pop all of your questions and comments into the Q&A chat at the top of the screen as we go along. Speaking of Vectrin, let me take a moment to introduce Vectrin to any newcomers. We are a SaaS platform founded on the principle that no B2B credit, collections, or AR department should be reliant on outdated manual paper-based processes. So we were founded in 2010 with the goal of using the power of automation to make your lives as credit professionals easier than ever. In our time, we've reduced the cost of collections by as much as 90%, increased the productivity of our users by more than 80%, and automated 100% of bank and trade reference checks. Today, we're talking about mitigating credit risk, and this topic is close to our hearts because making processes more uniform, creating models to help you identify areas of risk and exposure, these are all things we were literally created to do. Our technology is all about mitigating as much risk as possible so that you can make more informed, consistent, confident credit decisions every time. Joining me today is Dhruv, one of our product and implementation leads. Dhruv's been with Vectrin for over 4 years now and has spent his time helping our users develop models that replicate the decisions and criteria credit managers look at to determine a borrower's credit worthiness, all in an effort to speed up the decisioning process. Dhruv specializes in working to understand common problems our clients face and turning those into opportunities to build out products that alleviate pain points and operational bottlenecks. Me, on the other hand, for those of you that I've not had the opportunity to meet yet, I'm Nikki, Vectrin's Director of Marketing and Communications. So what that means is that I am here to listen to our clients and trying to make sure that I'm finding strategies to meet any challenges our product development head on. I'm here to educate our users on what we have to offer and how to get the most out of the platform, and of course, fostering more communication between our users so that they can learn from each other. I also serve as the liaison between our partners throughout the industry and lead all of our credit and all of our internal and external communications. If there's something new going on with Vectren and our services, chances are I'm the one that will be telling you about it. All right, that's enough about us. Let's dig into our topic today and start talking about the globalization of business. Here's the long and short of it. Companies need to think globally in order to survive. That's really it. That's the big secret. As you can see from this stat on the right, almost half of all companies in the S&P 500 stock index have sales coming from overseas. 18 US-based companies were included in the 2020 World Investment Report for the world's top 100 multinational companies. Now, that's almost 20%, and that was already 3 years ago. I can guarantee you that that number is higher, and it's just going to continue to grow. In order to remain competitive and profitable in this day and age, firms must operate as efficiently as possible, and they have to produce their products at the lowest possible cost. It's an extremely competitive global market. In order to grow, businesses join the global environment to expand their client base, and they do this especially in industries that are already oversaturated in their own areas. In many instances, expansion makes more sense than just producing a new product line in an oversaturated area. The opportunities available in other locations are often just more competitive. I mean, realistically, the more options you have, the more you can work the decision to your advantage. So that's the reality. Globalization is pivotal, but what makes it so beneficial? Let's talk about that. One of the number one reasons companies continue to move toward globalization is because the emerging technologies available in different parts of the world offer such a competitive advantage. Having access to new tech can help you produce faster, have better delivery systems with more diverse supply chains, and have easier access to new target demographics. Similarly, no company wants to rely on a sole economy. If something goes wrong and you're reliant on just one economy, well, we all lived through 2020. If something goes wrong, you're limited just to that area. Your product is entirely dependent on the fluctuations in that economy. Globalization secures competitive growth in up and coming areas, while the much more developed world tends to move at a slower growth margin. You're also able to find lower cost ways to produce products, which ties back to what I said earlier about turning opportunities into advantages. And along the same vein, by expanding into other areas, you're also creating more opportunities in the form of employment options. Talent is a big factor in globalization. We hear from our clients that diversity and talent is a huge bonus for their company growth. You want to have a lot of different people with different backgrounds in the room when developing new products and services so that you can benefit from their lived experiences and unique perspectives. We have seen that firsthand here at Vectrum. We have offices both in the US and in India, and they're both filled with people from different countries, different regions, different professional backgrounds. And when we come together to solve problems and face challenges, we find these perspectives drive more innovation. Again, too, I mentioned supply chains earlier, but it's worth hitting again. If we've learned anything, it's that you want to have backups for your backups. You need redundancies in place so that no matter what happens, you can get your products out to your buyers. And diversifying your supply chain through globalization is the best way to do that. So here's a visual representation of this move to globalization that's been consistently happening over the last 40 years. As you can see here, back in the 80s, the vast majority of businesses were solely in developed regions. Then, as we climb into the 90s and early 2000s, the shift began to move from exploring emerging markets other than China towards having a stronger dependence on China. In 2010, as I'm sure you all know, we increased our reliance on the greater China economy and began putting more footholds there. But in more recent years, the focus has been on finding opportunities in other areas throughout Africa, Europe, and Asia. In the next couple years, the estimation is that the global Fortune 500 will be almost half and half in developed regions and emerging markets. And the emerging markets total share is just anticipated to keep rising. Businesses are now honing in on previously untapped areas exactly for the benefits we just discussed. But of course, any new territories come with potential risk. So let's talk about those. While the benefits are plentiful and emerging markets absolutely increase profits and opportunities, the reality is that when you expand your client base into new areas, you risk not getting paid. That's why it's imperative that you try to identify and go ahead and prepare for any potential challenges and have strategies in place for when those scenarios arise. Obviously, the hope is that you never have to worry about these things, but we have to plan, right? We need to be prepared because what's worse than running into one of these risks is running into it and being caught off guard. The only way to operate efficiently in any market is to be well prepared. So, what are some of those scenarios that we're talking about? The most common one is probably political instability. Think about the war in the East right now. The Russian assault on Ukraine closed the port of Odessa and has decimated production in those areas. Actually, just in the last 24 hours, Russia pulled out of a deal they had to allow Ukraine to use the port solely for grain supply. So everyone's had to pivot yet again as Ukraine tries to get actual food to its people. Products are certainly on the back burner. This is just one example, and it's extreme one, but it's pivotal for businesses to analyze any region they're expanding into and assess the political factors at work. Is there any turmoil under the surface ready to bubble over? I mean, obviously, it's impossible to predict every scenario, but you have to try because the only way you'll be able to have a strategy in place for if you need to like pull out of that country, move locations, or put a hold on production is if you've tried to plan. Similarly, fluctuations in currency rates are another factor of friction and potential risk. We've worked with several of our clients on this one specifically. How do you report on currency exchanges correctly when the conversions are fluctuating? How do you continue charging your customers correctly? And how do you continue taking payments from currencies that are fluctuating? This is something that we've seen happen firsthand, and it's fairly common occurrence for emerging markets. You'll need to anticipate this, and you should really have a robust collection solution in place so that you can continually adapt to challenges like this. Here at Vectren specifically, we can speak to the fact that we've worked with our clients to ensure that our software helps them accurately monitor and manage currency rate exchanges, both effectively, but also while maintaining ample reporting. That gives them a serious advantage. Another risk that's an obvious barrier for expanding into emerging markets is communication. This is one that seems so obvious, it's easy to overlook when planning, but it's absolutely crucial. And by the way, this doesn't just refer to knowing the literal language of the communities you're moving into. I mean, that's obviously important, but what I mean here by communication barriers is also the difficulties that come from not knowing the cultural expectations and norms. You'll want to research these ahead of time to avoid any faux pas and also hire people specifically to communicate with new hires and potential customers. Throughout the world, work culture varies greatly. And if you have a headquarters in the US and then expand into Europe and Asia, there are certain nuances in relational interaction, not to mention literal differences in laws and expectations, that you are not going to be aware of unless you're properly prepared. Finally, here we have availability of quality credit information. This is again one that some businesses may take for granted when expanding because, frankly, excuse me, frankly, we're a little spoiled here in the US. We have a lot of data on customers. We can see everything from buying habits to comprehensive financial histories with little effort. Often with a single click of a button if you have a direct integration to your preferred credit bureaus like Vectren does. But not every area has the same level of reporting. In some parts of the world, you may be relying on unaudited financials, word of mouth, or even sometimes nothing at all. You'll have to make the judgment calls based solely on the information in front of you. So, how do you manage that? How can you consistently make quality lending decisions? This might seem like a difficult challenge to overcome, but the reality is we run into this here in the US too with brand new businesses that have no possibility of background data. You adapt to that by creating a list of criteria, using that to label the company a risk level, and then lend them an amount that meets your acceptable exposure threshold. Go ahead and adapt that same model to potential emerging market customers, and you'll be prepared for the likelihood of little credit information. Now that we've talked through the most common scenarios that bring risk in new territories, let's talk through even more considerations to mitigate risk. I've touched on some of them, but let's dive in deeper. Here's where you should be focusing your time and energy to proactively mitigate potential risk. And frankly, these are just solid recommendations for businesses, whether you're a global business or a local business. Whether you have multiple locations across four continents or one brand, these are universal best practices to help mitigate risk. We have companies that don't necessarily have locations in other countries, but they do ship to those areas and they have significant customers and buyers in them. When you have supply chains that are spread out and diversified like that, it puts you in a much better place. You want to make sure that you're diversified enough so that you can handle potential disruptions, but at the same time that you have to be prepared to operate in those areas as if you were there yourself. So, first, we always recommend that companies focus on relationships. When you work with anyone, whether it's your biggest customer or the person across the street, you have to have an effective understanding of the people you're dealing with. This goes back to the conversation earlier about making an effort to understand the work culture of the places you interact with. It's really important to understand how you need to get the work done in a way that meshes best with the people you're working with or serving. Next, learn the language. Again, this sounds obvious, but you have no idea what opportunities you miss out on when you can't easily converse with the customers and employees in your new regions. And by the way, a lot of learning a language is also learning the colloquialisms and the phrases and casual conversation techniques apparent within the language. This is something that we see firsthand here at Vectren often as a company with a highly diverse staff and diversified clientele. English is a very metaphorical language. We use sports analogies and exaggerations on a daily basis that leave non native English speakers baffled. Think about things like this when you're expanding into new regions and make the effort to not only learn the communication style of the new region, but also keep your own metaphorical uses to a minimum. Next, learn customs. This is pivotal. In order to know when your products will ship in and out, how to package and ship it, how to properly plan timelines, all of this relies on you understanding the nuances of customs requirements. This is also a good way of ensuring that you're not doing business with fraudulent customers because if you have a solid handle on customs requirements, you'll be more easily able to spot fake addresses or spot fishy shipping addresses. Next, political risk. We talked about political instability earlier, and I'm hitting on it again because it's so important. You don't want to only look at the political landscape at present. You want to also anticipate the political landscape of the future. And having a solid understanding of where the company is headed and how it will affect your business operations is crucial in order to plan any risk mitigation strategies. One way to better anticipate that is to take advantage of country risk reports out there and really leverage trade reports. Use trade reports for international businesses like CoFace, Euler Hermes, Business Intelligence, and also look at the companies on the restricted list from the Department of Commerce. Make sure you're always checking and up to date with the names on that list. Like, check it daily. That way, you're better able to catch any potential problems. Obviously, this data is available, but it isn't particularly robust and it is in various locations. So, you want to find tools or partners that can help you aggregate all this data and give you a holistic view of the potential customer you're going to be working with. Finally, try to remain consistently active within industry groups. This ties back in with building relationships, but it's worth talking about again. There are a ton of resources available to you when you connect with other businesses, both within your industry and outside your industry, but in a similar business model. For example, we love connecting with our veteran users at our user group meetups. But what I personally love even more is seeing our clients connect with each other and learn from each other. We have companies, for example, in the food supply industry, connecting with companies in the construction and roofing industry. Two very different business models and margins, but they're both looking for better ways to build out an automated credit application, and they're learning tips from each other. Take advantage of opportunities like that and learn from those around you. It'll be invaluable to lean on your connections within credit groups when you're looking at new environments. This probably won't come as a surprise to anyone, but what we have here is the most recent country risk map. Uh, Excuse me. This is from 2022, and it shows, for one thing, the upgrade to the high risk status that Russia received after invading Ukraine. But a few other callouts here. Cameroon improved by one level as their gas production began accelerating. Let's see. Argentina's inflation spike also caused them to fall a slot. They're now in the high risk category. Um, Not changes necessarily, but just to keep in mind, the US is facing constraints with higher borrowing costs, and China is still considered a medium risk due to lack of manufacturing competitiveness. Overall, a map like this is very high level, and it's meant to give an idea of what could happen when you're considering expanding into other areas. And again, this applies even if you aren't actively establishing a physical business in these areas and are simply shipping products or partnering with other businesses there. You still want to ensure you're checking the country's risk status and factoring that in to be able to fully evaluate and make the most informed decisions for both yourself and your company. Now let's dive into those actionable strategies for risk mitigation. I know that's what everybody's actually here for. So, as I'm sure everyone is aware, it's simply impractical to attempt to manage total credit risk manually. I mean, it's just extremely difficult to do that, even if you have a small business, and it becomes essentially impossible at scale. What you need is a global and integrated credit management infrastructure, complete with excessive reporting, tracking, oversight. That way, you're better able to stay abreast of your accounts, your financial status, and your exposure. The good news is it's entirely possible and super easy to implement a system like this in just a few weeks. The reality is that much of the B2B credit industry has still not fully taken advantage of the technology that's out there. And digitizing your credit collections and AR process are simply the best way to maintain visibility into your accounts, mitigate risk, and stay competitive. You also need to make sure that you have a standardized credit risk assessment process in place that is universal and consistent among every branch, every credit professional, everything. You want to have a standard policy in place that can be easily replicable and serves as the gold standard for your lending decisions. Creating a standardized process is crucial for every lender, frankly, global or not. I mean, you want to ensure that every decision that comes through is being held to exactly the same standards. That's pivotal for not only mitigating risk, but also for making informed decisions. But this is even more important for companies looking to operate globally. You want to have a replicable process in place that can be used no matter where in the world you're doing business or what information you have in front of you. The really important thing here is that you have a process that is solid and replicable, but also is adaptable and allows room for nuance. Because, as I said earlier, that's going to be the reality in some of these areas. For example, let's say you have a global risk assessment policy in place, and it says that you need to have effective credit document collection for all the new customers, and then also designated order and method for who is approving and denying that application. That's great. See, that right there is a great outline of a policy because it's replicable, but it also allows for nuance. So, what that nuance could look like is what the documentation actually is. In the US, that document collection could be running a driver's license, verifying credit info with someone like Experian or DNB, and then making a decision. But then in Europe, maybe what that documentation is requiring a passport and business address, and then verifying not only the business address, but the IP address is matching that business address. These are all real life examples that we've seen here at Vectren, and it's a great way to show that the process remains universal and standard, but it allows for those nuances and those differences. Next, credit lines across multiple currencies. This is again crucial for international businesses. You need to be able to evaluate credit lines across multiple currencies for businesses that operate in multiple countries. Let's say the CFO wakes up one morning and he asks you how much credit your account has in US dollars right now. And you're over here looking at an account setup with branches in 10 different countries. How do you make sure that you have an accurate view of your extended credit at a glance? Again, leveraging technology to make sure that you have a comprehensive snapshot is the answer. It's the only quick and accurate way you're going to be able to look at your exposure and manage the account efficiently. Similarly, you're going to want to ensure that your credit application works for customers you're trying to reach. Even here in the US, the best way to do that in certain areas is to have an application that's easily readable and accessible to your clients. Setting up multilingual applications is the perfect way to avoid any confusion, friction, or lost business. We actually have a few clients who have bilingual applications set up already. um, they'll have English in one line and Spanish right below that, for example, so that it's accessible and legible to both English and Spanish readers easily. And everyone's seeing exactly the same information. Another point for stopping problems before they arise is having multi currency financials set up within your system. Again, you want your applications and the collections and AR processes to work for your customer, not against them. That's the best way to prevent repayment bottlenecks. Make it as easy as possible for them to pay on time. So, one way to avoid putting the burden on your customers is to have conversions built into your process. For example, and again, tech is great for this, you could use a digital platform that would handle all those conversions automatically for you. Again, always take the time to not only look at the country risk map, but also to make sure you're understanding what is contributing to those rankings. Leverage your network and really dive into those political landscapes and have all the information in front of you on what risk you'd be getting into before you make your decision. I've mentioned this a few times, but one of the best ways to help you get a holistic view of your current and potential risk is by having a digital credit application tool. Having an electronic system that aggregates data automatically and keeps you apprised of conversions, exposure, credit lines, everything. This is the best risk mitigation tool in the toolbox. I've touched on some of these already, but here are just a few benefits that you can get out of an electronic solution. First, upfront collection of prospect data. You aren't having to go back and forth with the customer and say, hey, you didn't put in your full address, or wait, I don't have your signature on here properly. You're getting all the information you need up front because a digital solution can actually prevent the person from hitting submit until they add the information you say is required. That way, you're only spending time on complete applications. Corporate registration verification is a critical component of that documentation I mentioned. So is driver's license verification. And with an electronic system, the system can actually pull that verification information in the background and have it added to the application and the account and waiting for you when you're ready to view all the documentation together. So, what does that look like? Um, so SOS, that stands for Secretary of State. Here in the US, that's the primary way most states verify driver's license. So basically, what this looks like in real time is that your customer fills out the application online. They forget to put in the address, or maybe they type in the address incorrectly. And the system flags it immediately and makes them go back and verify and type in the correct address. So you are seeing a completed application plus, as soon as they submitted that, the system starts verifying their business license with the Secretary of State through our SOS integration. By the time you see the application, you have credit reports from DMB in front of you, a verified corporate license, a verified driver's license, and a full application. And now you're ready to make an informed decision. Similar to this, ACH validation can be done through the system for you so that you're not having to do that manually either. So with our system, obviously that's the one I know super well, so that's the example I'm going to keep using. But with Vectrin, we can integrate directly with any payment gateway and any vendor you prefer. And once that setup is complete, then when your customers enter their ACH information, it'll be checked automatically. Next, fraud prevention and alerting. This is a huge one that you absolutely want to have set up, and it's something that a digital system is going to be able to offer you that the manual processes simply cannot. This is one of the more important aspects of credit systems to have. And what this looks like is the ability to track and monitor potentially fraudulent activity right from the outset of the application process. So I mentioned IP addresses earlier. This is one of those things that Vectrin checks for during the application process. What do I mean by that? Let's say you get a credit application and the business address is located in the UK, but then you see an IP address that's pinging towers in North Korea or Sri Lanka. That's suspicious right there. And that is something that you need to look into. But at scale, you can't do that on your own. So you have to have a solution that does that for you. And it's even better if you can have a system that can do even more, like tracking IP network scores or IP blacklisting, and marry that with information about whether the phone number even belongs to that business address, or whether the domain was just created yesterday or actually created 10 years ago when the business claims that it started. All of this information is critical in being able to catch bad actors before they're able to strike. With a comprehensive solution, the machine is doing all the work for you so that you're reducing the high volume of repetitive tasks, and you're also reducing the opportunity for errors along the way, or simply preventing insufficient information from clouding your decisions. When you have a system that's leveraging the power of automation, you can also avoid the incorrect setup of customer master data or payment methodology that could cost you massively in the long run. You can streamline the customer setup in a way that avoids heavy lift with that zero ROI in the beginning, and it just immediately launches you into that positive revenue stream. All in all, a system that provides these things will lead to faster approval times in the end. And that means that you have all the information you need to make more informed and consistent decisions every time. That gets you back to focusing on what's important for business growth and leaves you with more time for high value strategic business initiatives instead of spending time fishing through different platforms and wading through documents on your own. The system gives you support. Another aspect of the automation framework that is comprehensive is enhanced scoring evaluations and decision models. These things mean that you don't have to try to factor in all this information yourself. You don't have to wade through stacks and stacks of data to decipher it all on your own. The system can pull that data from various sources and send that all directly to your ERP. You no longer have to make decisions in a black hole, hoping you found everything and hoping that you deciphered it correctly. You can Effectively evaluate your customers with trusted payment history and data all pulled directly into their account and kept in one place for your whole team to see. And the system will aggregate and assess it all also and give you a score based on the pre-configured criteria that you've told it is most important. Another example of the benefits of automation, data pattern matching and automatic credit approvals. So you'll have a better understanding of risk once you have the ability to see risk parameters holistically. And any solution that you get should be one that has the ability to configure these risk parameters and say, okay, if this meets these specific requirements, then start a review. Or these levels of criteria have been met, so this application should automatically be approved and just sent to a credit manager for sign off. Some examples of things that could automatically trigger a credit review would be credit limit utilization, past due balances, payment behavior. At the end of the day, machines have a far greater capacity to ingest, digest, and recognize patterns within data than humans do. So the machine can recognize within a fraction of a second things like, hey, this account is usually paid within 30 days and has been that way for 10 years, but these last three payments have been 60 days out. A human should really review this and see what's up. So once a review is triggered, the assigned credit manager is then notified and they'll be able to review the process. The entire thing should be able to be fully automated so that your team is having to do a minimal amount of labor, ideally zero amount of manual labor. That's the goal of technology. It should work for you. Another piece of this full automation is having what we here at Vectren call IDM, the Instant Decision Manager. The IDM does part of the work for you, and it would go ahead and approve these easy, no-brainer applications. So the for example, with Vectren's IDM, the machine looks at all credit applications first, and only the ones that aren't easy approvals are sent through for full credit manager review. So, for example, if you have an application come through with fantastic credit bureau data and a payment history that shows 10 years of early repayment and the credit limit requested is well below your designated exposure threshold, well, then that would be approved and you wouldn't have to waste the time on it. But if an application came through with missing data or an inability to verify one of the documents or the scoring model rating it as high, like would rate it as high risk, that application would be kicked back to the credit manager for a full review. And the manager could do some additional evaluation or maybe adjust the credit limit or payment terms or make the approval conditional. There are all kinds of ways to ensure that the system is doing the work for you. So you shouldn't so that you can spend more time on high value initiatives. But that doesn't mean that anything would simply be overlooked or denied outright. You're still in full control at the end and you're simply just reclaiming your time. All right, finally, what does this look like in an electronic environment? You've heard me talk about the scoring models and the configurations and the automation frameworks, but what does all of this look like in a real world setup? Here's an example of what those currency rates would look like and how you're able to rate country risk levels based on your research and your own goals and build the weight of that score into these models. You can see an example here too of a robust set of financials. Obviously, it's really hard to look at the entire scope of a comprehensive platform in a few screenshots. So this is just a high level overview to put into context some of the things we've been discussing today. But if you'd like to see the full scope of what this looks like, we're always here to do a more in-depth demonstration. Just reach out. And that's it for our discussion today on credit risk mitigation at a global scale. I appreciate every one of you that's joined and all of you taking the time to listen in today. We have a few minutes left for some Q&A time. If anyone has any questions, I would love to see those. Please just drop those into the Q&A functionality at the top of the screen. Anything we've discussed today or any questions that you have really at all, go ahead and pop those in and we'd be happy to answer them. Otherwise, I'll turn it over to Dhruv and see if he has anything to add. But if not, that'll be it for us today. All right. I don't see any questions coming in. Dhruv, did you have anything to add?
I'm good, Nikki. I think you covered all the points. Thank you so much.
Fantastic. Well, then, thank you everyone for joining us today. Here's our contact information if you like it. As I mentioned at the beginning, this slide presentation and the recording from today will be shared with everyone later this afternoon, and we're always available if you have questions at a later time. Thank you all so much for spending part of your day with us, and I hope you all have a wonderful week. Have a great weekend. We'll see you next time.
Thank you, everyone. Have a good one.